Hello everyone, this is Melanie, and this is the solutions video for your math questions from section 4.3 of your course. We find that a lot of students have a lot of difficulty in solving these on their own, especially if you have math anxiety. So we decided to do this video in order to show you detailed solutions so that you know how to solve them and you will be confident when you get these questions on your exam. And I just want to add that you shouldn't be using this video to shortcut your work. Okay, so what I mean by that is this video is here to help you if you are stuck and you just cannot figure out a solution. This video is not meant to be a crutch that helps you just get through things so that you can check this area complete. If you do that, you are going to cheat yourself of being able to solve these. And honestly, the math and the math type questions are the ones that you want to be perfect at, because these are the ones that you can actually know and be confident that you 100% got the right answer. So we want you to be comfortable with these. They're not difficult. It's just the trick is to know where stuff actually gets put on each statement. And you'll see that in the majority of questions that I go through here, I will actually do both the buyer's and the seller's statements at the same time, even though the solution is only asking for the result from one of them. And the reason for that is because sometimes it's easier to spot the mistake that you're making when you can see both statements sitting there in front of you. So there's nothing wrong with doing extra work while you're practicing. And you know what? If you even need to do both statements when you're on your exam, that's okay too. But the key to that is you need to practice to get your timing down so that you're not spending too much time on each question from this section. All right, so with that said, let's get started and we'll go through each of the questions in detail. So the first thing I want to cover is the calculations around the PTT, the property transfer tax. So that's what that PTT means. And basically, property transfer tax is payable by anybody who is buying property in our country, but particularly in our province. So you will learn the details about property transfer tax in one of your other chapters. So don't worry about all of the criteria and the details for now. For this chapter, you just need to know how to actually do the calculations. So just the mathy type part of it. So there are 4 tiers, and then there is actually a foreign buyer extra that you need to remember at the very end. So the reason why I have tiers 1 and 2 highlighted is because those are the tiers that you are probably going to be working with for the questions that you're given. Most of the property prices that they give you are somewhere in the neighborhood of $500,000 or less. And so the first 2 tiers covers the first $2 million. So the majority of questions you'll be fine with just knowing how to do the first and second tier. But if they give you questions that are for larger amounts, then you still do need to know this. So you need to know these tiers and how they break down exactly this way. Don't recombine or change it. Just remember it exactly this way. And you need to be able to do the calculation for all of the tiers and the bonus tier. So how does it work? The first $200,000. So for every property purchase, always the first tier is the first $200,000, and that gets charged a 1% tax rate on it. So if you had, a $200,000 recreational property, you would just pay the 1%. If you had a $400,000 recreational property, well, that spans both tier 1 and tier 2, and so we would charge that 1% on the first $200,000, and then the remaining $200,000 of that $400,000 property would get charged a 2% tax on it. So the first 2 tiers cover all the way up to $2 million. Now you're not going to charge the 2% on the first 200,000 because you already charged this 1% on the 200,000. So you don't double charge. You don't do the 1% and then do the 2%. You always subtract this $200,000 off of whatever the sale price or market value of the property is, and then you charge the next tier, tier 2, on whatever is remaining. Okay, if we have a property that's over $2 million, that's $2.5 million, then we would be into this tier 3. And the amount that's over 2 million, we would need to charge a 3% tax rate on that. So you see that the range here is anything over 2 million, $2 million and $1, up to an unlimited property price. So if you had a $20 million property, then you would be charging 3% on the 18 million that is over and above the first 2 million, because those are covered in the first 2 tiers. Okay, and then in this province, for whatever reason, anything that is a residential property, if the amount is over 3 million, you get charged an additional 2% on top of all of the other tiers that you've already paid. So again, that is an unlimited price amount, and you would need to calculate that over and above the other 3 tiers that you've already done. And if you're a foreign buyer and you're buying residential property, for specific areas in BC, then you are probably going to need to pay an extra 20% of the market value or the sale price, whatever the case may be. So in some cases, foreign buyers might be able to dodge that, but you'll learn about all of those details in one of your other chapters. Okay, so the first example we're going to do is we are going to calculate the PTT, the property transfer tax, on a $1.4 million property. The buyer is not a foreign buyer, and it is a residential property. So you need to pay attention to all of those details when you're reading your questions. So the first tier, again, is that first $200,000, and it always gets charged the 1%. So that amount is $2,000 for tier 1. Because we're above $200,000 for property value, we need to go into the next tier. So we would charge on the $1.2 million remaining. Again, we don't charge the 2% in tier 2 on the 200,000 here in tier 1 because we already charged the 1% on it. So we just do the remainder. So 1.4 million minus 200,000 is 1.2 million. So we charge a 2% tax rate on the 1.2 million, which would give us $24,000. Now, because we are not over a $2 million value, we don't actually charge anything for tier 3, and we don't charge anything for the bonus tier, and we've said that this is not a foreign buyer. So for tiers 3 and the bonus tier, nothing is applicable, no taxes are payable, and the foreign buyer is also not applicable. So you would add up both of your tiers here, and you would have to pay as a buyer of this property $26,000 in PTT. Okay, so the next example is we're going to calculate the PTT on a $3.4 million property. It says in the question that they're not a foreign buyer, and it is a residential property. So we always charge that first tier, the first $200,000 at 1%, so that is our $2,000. Then because we are over 2 million, we have to charge tier 2 as well, so we charge the remainder, right? Not the entire 2 million, we charge only $1.8 million at 2% for a tax amount for that tier of $36,000. Because we're above a $2 million property, both the bonus tier and tier 3 apply. So we would charge 3% on the $1.4 million above 2 million for a amount of $42,000. And then because we're above $3 million, we need to charge 2% for that bonus tier on the $400,000 that's above 3 million. So that is an $8,000 amount for the bonus tier. For this one, we said that the person was not a foreign buyer, so the foreign buyer's extra 20% tax is not applicable. So for this one, you add up all of your tax amounts. So you have your $2,000 from tier 1, your $36,000 from tier 2, $42,000 from tier 3, and your $8,000 from tier the bonus tier. And so you would have a total tax bill of $88,000. Okay, so the next example, we are going to calculate PTT on a $4.4 million property. Now, if they had in the question that they were a foreign buyer and it was a residential property, then we have quite a few calculations to do. I'm also going to show you what the bill would be and kind of where you would stop for calculations if they weren't a foreign buyer as well. So again, Tier 1 is the first $200,000 at 1% for $2,000. Because we're well above $2 million, we have the full amount taxed in Tier 2, so the remaining $1.8 million at 2% for an amount of $36,000. And then in Tier 3, because we're $2.4 million past $2 million, we need to charge 3% on that $2.4 million, and we would get an amount of $72,000 for that tier. So these are the main three tiers, but because this is a residential property, we need to actually apply the bonus tier as well. So on the amount above 3 million, so that's 1.4 million, we would charge an additional 2% for another amount of $28,000. So if you were not a foreign buyer, if the question said not a foreign buyer, then you would stop right here for your calculation. So you wouldn't go any further. And this would be, these three tiers in the bonus tier would be all that you owe. Okay, so we'll do that math in a second. And then, but because this one we said that, yeah, we do want to see what it would look like if they were a foreign buyer, so we need to actually apply that extra 20% to the full price, so to the sale price or the market price, usually is how they'll phrase it in the question. 20% on that 4.4 million is $880,000. So for this one, if you were not a foreign buyer, you would pay a PTT bill of $138,000 because you would just add up all of your three tiers and then add that bonus tier. If you are a foreign buyer, you need to add that other $880,000. So you would end up paying a total PTT of just over $1 million. So it would be $1,018,000. And when you do a question like this, it just shows you how much more foreign buyers do need to pay in taxes when they purchase property here in British Columbia. All right, so the next example is we're going to calculate PTT on a $4.4 million property. For this question, we're going to say that they are a foreign buyer. And we're also going to say that in this case, it's a commercial property instead of it being a residential property. So remember I was saying that you need to pay attention to the details in the question. This fact here, this fact that it's a commercial property, tells you that you don't need to worry about the bonus tier and you don't need to worry about the foreign buyer tier because it's not a residential property. So the fact that they're a foreign buyer doesn't really make a difference for this calculation because only the first three tiers apply to the purchase for that PTT amount. So it's a lot easier to calculate than it might look because we only do the first three tiers. So again, the first tier, again, that $200,000 at 1% for the $2,000. And then because we're past $2 million in our tier 2, we do the remainder of 1.8 million at 2% for $36,000. And then because we're past that 2 million, we need to do a tier 3 at 2.4 million at 3% for $72,000. Again, because we're doing a commercial property calculation here, the bonus tier doesn't apply. So I know that it's over 3 million, but that only is for residential property. It's not for commercial property, and the foreign buyer tax wouldn't apply either because it is a commercial property. So you would just add up your three tiers, and that would be, I believe it's $110,000. Hopefully my math is correct. I'm doing it fast here. So $110,000 $110,000 PTT bill if you were to be the buyer that was purchasing this property. All right, so let's start with question number 1 from the math quiz. So there's a lot of information in this question, but you just sort of pick out the stuff that you need and you deal with things one at a time. So don't get stressed about it, just sort of deal with it in an orderly fashion. For these ones, because of the way they've written them, I like to deal with things as they're written. If it's kind of more in a grid style, you can sort of pick and choose what you want to deal with, and then you can do the more complicated stuff last. But for this one, for these types in this style, I like to just deal with things as they give the info to you in the question. So the first thing we're going to deal with is the price here that's highlighted in yellow, $75,900. So we need to record that on the statement. So we need to choose where it's going to go, if it's going to go on each person's statement. So when we have a purchase price, it has to be put on both the buyer's and the seller's statement. It would be a debit to the buyer and a credit to the seller. So remember, the same amount, the same dollars that represent the exact same thing, they need to actually be in opposite columns. So you see that it's in the debit column for the buyer, and because it's the same amount of dollars that's being put on the seller's statement for the same item, then it has to go in the opposite column. It'll go in the credit column for the seller. The next thing we're going to deal with is that real estate commission. So the seller pays the real estate commission. They're nice enough to actually say that to you in the question. It's paid by Victor, and it's for 7% of the selling price. So we need to debit that to the seller, and that will not show up on the buyer's statement. So when you do 7% of $75,900, you get $5,313, which you see has been put into the debit column for the seller. The next thing we're going to deal with is Pamela's deposit of $2,000. It says that the real estate brokerage has passed it to Pamela's lawyer to be deposited in a trust account until the completion date. So this is being handled by the brokerage and the lawyers. It is not going directly to the seller. So that deposit will be a credit to Pamela, and it will not show up for the seller on the seller's statement. So a lot of people get confused as to why deposits are credit instead of a debit. Yes, Pamela is paying that money, but it is being paid against the purchase price. So we need to give her credit for it so she doesn't pay the full amount again. So if we were to put this $2,000 in the debit column by accident, instead of the credit column, then if you actually add these together, you see that we're now making her pay $77,900 for the property, and that isn't what was agreed to. We just bumped up the price. So we need to make sure that we put that in the right column. We need to put it in the credit column. Okay, the next thing that we're going to deal with is the diamond ring that Pamela is going to give to Victor. So for this diamond ring, that is going to go to Victor. So we need to actually include that on both the buyer's and the seller's statements for this one. So you see that we've done that. We've credited that amount that the ring is worth to Pamela, because again, we need to she's going to give that ring against the purchase price. So again, if we accidentally put this $7,500 in the debit column here, then we would just be bumping up that purchase price by $7,500. So we don't want to do that. We want to make sure that we put it in the right place, and we have to put it in the credit column. For Victor, it needs to go in his debit column, because we need to say, hey, she's given that thing that's valued $7,500, so we need to take that off of the purchase price because he's already getting that item and that value for that item. The next thing we're going to deal with is the $65,000 that Pamela is going to borrow from the bank of Dad. So she's getting a loan from her father, and we need to put that on her statement. For this one, it is nothing to do with the seller, because the seller isn't actually providing that money, so the $65,000 won't show up on the seller's statement at all. So you see that we've put it in the credit column for Pamela. And again, why are we doing that with mortgage monies? because if we put the $65,000 here in the debit column, now we just bumped up the sale price of the property by another $65,000, and that's obviously not what she's intending to pay. So we need to put that in the credit column to take that off of the price that she owes. The next thing we're going to deal with is the property taxes. So it says here that the current year's property taxes were due in the amount of $896, and Victor already paid them. So for this one, we have a little bit of a calculation to manage. So we've got to actually see what portion Pamela needs to pay to Victor because Victor already paid. So for this one, we would need to calculate Pamela's portion, and the reason why we do that is because the completion adjustment dates are going to be November 14th. So she's going to be in the property for a tiny little amount of time. So we would calculate her portion, we need to debit her that amount, and then we need to credit that to Victor, to the seller. So this is the calculation broken down. So it says the full year's amount is $896 and that Victor already paid. We need to figure out her portion, the buyer's portion, from November 14th down to December 31st. So how do we do that? We count the days. And for finding the buyer's portion, I like to count backwards. So December has 31 days and November it has 30 days, but we're not going to charge her for all 30 days because she's only going to be in the property from the 14th. So there are two ways that you can figure out the number of days for November. So depending on kind of which way your brain works best, you can take the number of days in the month and you can subtract that adjustment date off. In this case, that would mean there are, 16 days left in the month. So if she moves in on the 14th and we subtract those 14 days off, then there are 16 days left in the month. But for this chapter, you need to remember that the buyer is always responsible for the actual adjustment day, and we just subtracted that adjustment day off by doing the 30 minus 14, so we need to actually add it on to get 17 days. Okay, the other way is if you're finding the buyer's portion, this one's maybe a little bit riskier. If you're finding the buyer's portion, you need to back up that adjustment day by 1, and so you would back it up to November 13th, and then you would just get your 17 days. You do not do this with the seller. When you're calculating the seller's portion, it's a little bit different, so you've got to be careful that you don't just do that all the time. Okay, so you can only do this when you're finding the buyer's portion. Okay, so then you take your days. So for November, we said it was 17 days, which is 48 days total. So you take your days, you divide it by 365, and then you multiply that answer by the 896, and you get $117.83. So that is a debit to the buyer and a credit to the seller. You ignore that total amount of $896. It's not late. It was already paid, so it's not recorded. There's also a second method that you can use in order to calculate the dollars, so the dollar amount. I'll only mention it this time because the majority of people don't like this method. So if you like this method, it's okay for you to use it. I'm just going to mention it this one time to make it so that you know it's okay. So basically you can take this $896 and you can divide it by 365 days in the year. And so basically what you're figuring out is you're figuring out how many dollars and cents per day the person would have to pay taxes, so for the property taxes. So it ends up being 2.4547 with a bunch more decimals, right? Because you're always going to have a calculator set to the 6 decimals. So you would get this amount per day, and then you would just multiply that by the 48 days, and you will still get your 117.83. Okay, so you see here that we've put that 117.83 in the debit column for the buyer and the credit column for the seller. The next thing we're going to deal with is the $600 for the legal and registration fees, and it says that Pamela's lawyer will charge that, so that is what we charge to Pamela. So it's a debit for Pamela, and it does not show up on the seller's statement. The next thing is the judgment registered against the title for Victor. So it says it's against the title and it's in the amount of $6,225, and there's a legal fee to remove it, which will be $85. Both of those are Victor's charges. So even though it says a legal fee, you have to make sure that you know who it is that owns that fee, that caused that fee. So Victor's the one that needs to pay both of these, so we would debit both of these to Victor, and they would not show up on Pamela's statement. And you see here that we put them together in the same line but kept them separate. So always make sure that you have all of your amounts separated out in some way, shape, or form, just so that you don't think that you maybe made a mistake. The last thing that we have to deal with here is that it says there's a property transfer tax that's payable on completion. So the new sort of method for solving is that you only calculate the PTT if the question mentions it. Now the majority of questions mention it now, so you don't have to worry about it, but if the question mentions it and it says it's payable, then you actually will calculate that and then debit the buyer. So you see here that we've done that. $759 is the PTT because the amount of the property is only $75,900, which means we're under that first tier of $200,000, so it's only 1% of the $75,900. Now the last little bit of info that you need to pay attention for is whether they're a foreign entity. So it says in this question that they're not a foreign entity, so we don't end up having to pay the extra 20%. So that is all of the numbers we've gotten, all of the values put into the statements, and now we can do our final tally. So how do we actually get the balance due for Pamela? Well, we add up the credits and subtract the debits. So the easiest way for you to do this is just look at the credit column and add everything up in the credit column, and then once you've gotten that number, which is $74,500 for this one, then you subtract all of the debits from the debit column. So you would subtract each of those to get a final balance due of $2,876.83. The reason why I say to add up the credits and then subtract the debits is because if you go from debit to credit to debit to credit to debit to credit while you're doing your math, you might forget whether you're adding or subtracting. So people get confused with that. So the easiest thing to do is to just look at the credit column, add everything up in the credit column, and then subtract the debits after you've added all up the credits. Okay, next question. We're going to do the same thing. So we're going to just deal with everything as they give it to us in the question. So the first thing we have to deal with is that purchase price of $150,000. Purchase price is a debit for the buyer and a credit for the seller. The next thing is the deposit of $15,000. So it says that it's going directly to the brokerage. So it's not going to the seller. So it will not appear on the seller's statement. So we put the $15,000 as a credit for the buyer. Remember, deposits and mortgage money are always credits for the buyer. So the next thing we deal with is that there's a mortgage registered against the title that has an outstanding balance of $71,000, which Paul is going to assume. So the buyer is going to assume the mortgage that is still on title. So the $71,000 will need to be put on both the buyer and the seller's statements. So it's a credit to the buyer. Remember, deposits and mortgage money are always credits to the buyer, and in this case, because it's the seller's mortgage that's being assumed, it needs to go in the debit column for the seller. The next thing is the second mortgage for $34,000. It just says it's a second mortgage received by financing. So that has nothing to do with the seller. So that will just show up on the buyer's statement and it will not show up on the seller's statement at all. So $34,000 in the credit column for the buyer. The next thing are the taxes. It's giving a little tiny bit of info here. So it says that a property tax of $1,095 were not paid by Vanessa by the due date. So the seller didn't pay, and then there's a penalty of $105 that has been added on as well. And it says the outstanding property taxes and penalty will be paid by the conveyancer from the sale proceeds. So what does that mean? It means that the statement of adjustments is actually going to take care of those unpaid taxes. So we have to take this $1,095 and the $105, and we have to actually debit the seller because they should have paid that. And then after that, we need to actually calculate the amount that the buyer would need to pay, because our adjustment date is August 31st. Okay, so let's take care of all of this calculating for the property taxes. So it says here that the full year amount is $1,095. The seller didn't pay, so we do need to debit that from the seller, and we need to debit the 105 as well. So we're gonna record both of those because they're late and they need to be paid. The seller should have paid it. The buyer shouldn't have to pay the full amount. So we're going to make the seller pay. Then after that, we would find the buyer's amount because they're going to be in the property for the lesser amount of time, and they're going to owe the seller for their portion. So we need to find the buyer's portion and credit it to the seller. So we're going to count the days. So December has 31 days, November has 30, October has 31 days, and September has 30. Okay, so that's the last 4 months out of the year. And then we are in August, so we're not for the full month of August, we're actually only from August 31st. So remember, there were two ways for you to do this. So you could actually take 31 days in August and subtract off that adjustment day, and you would get 0, but the buyer is actually responsible for that adjustment day, so we would need to add it back on, and you would get 1 day for that. Or the other version, when you know that you're calculating the buyer's portion, you can just back it up by 1 day, and you can go back to the 30th, and then you would just get your 1. So there's only 1 day for August. So when you add all of those up, you get 123 days. So we've done the calculation here. 123 out of 365 days in the year gives you this decimal, and then you multiply that by the 1,095 to get 369. So just something really quickly, you don't multiply it by the 1,095 and the 105. You only multiply it by the actual amount of the taxes, because the 105 late fee needs to be paid every penny by the seller who should have paid. So Vanessa, she needs to pay that 105. So we're going to debit that amount. It's the buyer's amount, so that we debit that to the buyer and we credit the same amount to the seller. So you see here we've done that. So the 369 is in the debit column for the buyer, and it's in the credit column for the seller. And then we have the 1,095 and the 105 penalty that is on the seller statement in the debit column as well. The next thing we're going to deal with is the real estate commission, 6% of the purchase price. It doesn't say so, but the seller is the one who would almost every time pay that real estate commission. So we would debit that to the seller, and it's not going to show up for the buyer. So $9,000 is the 6% of the $150,000 purchase price, and you see that it is in the debit column for the seller. The next thing we'll take care of is the conveyancing fees for the transaction. They're $600. The conveyancing fees is related to transfer of title, and that is the buyer's cost, right? So conveyancing fees or legal fees, if they don't explain who they're for, then you just assume that they're for the buyer. So those would be debited to the buyer, and they would not show up for the seller. So here they are put into the debit column for the buyer. And then the last thing that we deal with is the property transfer tax. It says it's payable. So we need to calculate the PTT for the buyer, debit that to the buyer, and it does not show up for the seller. So $1,500 is our 1%, right? Because we're in the first tier, the first 200,000. So 1% of $150,000 is $1,500. And it does say that Paul is not a foreign entity for property transfer tax purposes, so we don't have to worry about the foreign buyer's additional amount. So they want to know the cash proceeds of the sale for Vanessa. So what do? We add up all of the credits. So cash proceeds is the seller. Add up all the credits and subtract all of the debits to get an amount of $69,169. Okay, so the next question, let's just get right to it. So it says Violet has agreed to sell her home to Parker for a price of $150,000. So we'll deal with that $150,000 first. So the $150,000 purchase price is going to be a credit for Violet because she's the one that's selling her home. So remember, Violet is the seller and Parker is the buyer in this situation. And then it says that, so it's going to be a credit for Violet and a debit for Parker. Parker has paid a deposit that goes directly to the brokerage. So because it's going to the brokerage, we need to give Parker credit for that deposit. And we don't give credit or debit to Violet at all because it's going directly to the brokerage and it has nothing to do with the seller. So here you see that it shows up on the buyer's statement as a credit and it does not appear on the seller's statement. So the next thing we'll deal with is the mortgage that's registered against the title and it has an outstanding balance of $71,000, which Parker will assume. So it's an assumed mortgage, which means it is a vendor supplied, it is a seller supplied mortgage. So in this case, because the seller has something to do with it, we need to put it on the buyer's statement, but we also need to record it on the seller's statement. So for mortgages, for deposits, those are always going to be credits for the buyer. So we need to credit that $71,000 to the buyer and we need to debit that $71,000 to the seller because they will need to discharge that mortgage off of the title before they pass it on to the new owner. So credit for the buyer for that $71,000 and debit for the seller. The next thing is the second mortgage, so additional financing that Parker needs in the amount of $34,000. It just says second mortgage, so we can't assume that the seller has anything to do with it. It's just another way of getting money, so it could come from a family member, it could come from a mortgage lender, it could come from a B lender, private lender, whatever the case may be. So the $34,000, again, because it's a mortgage, it would be a credit for the buyer, and in this case, it doesn't appear on the seller's statement. Okay, so the next thing that is mentioned is the property taxes. It says that they were not paid by Violet, who's the seller, by the due date, and so there's a penalty on top of the property taxes being outstanding. So it says that they're going to be paid by the conveyancer by the sale proceeds. So that means that the buyer is going to actually end up taking care of that debt. So what we need to do is immediately we need to actually debit the seller for both the $1,095 and the penalty amount, so that we make it so that the seller did pay even though that they didn't. So we need to debit the seller the $1,095 and the $105, and then we look at the adjustment day. So the adjustment completion and possession day is August 31st. So from that, we see that the buyer is going to be in the property for the shorter amount of time, right? They're in for the last part of the year. So we find the buyer's portion, and then we're going to debit the buyer, and we will credit that amount to the seller. Okay, so you see that there's a $1,095 tax amount and the $105 penalty amount that are put on the seller statement as a debit, and then $369 is the amount that the buyer needs to pay to the seller. So we've debited it to the buyer and credited it to the seller. Now, how did I go about that calculation? First, you need to count the days that the buyer is responsible for, right? So we look at that possession adjustment completion day, and the adjustment day is the day that we're concerned with. So it's August 31st, which means the buyer is going to be in the property for the lesser amount of time in the year. So we would find the buyer's portion and we debit the buyer and we credit the seller. So you find the days. I like to go from the end of the year instead of from, the August 31st date. So December has 31 days, November has 30 days. October has 31 days and September has 30 days. So those 4 full months are all the buyer's responsibility. So that's 122 days total. And then we need to remember that the actual adjustment day of August 31st is also the buyer's responsibility. So remember, there are 2 different ways that you can do it. You can take the month that the adjustment day falls in. You can say how many days does it have in it. 31 days. You subtract the adjustment day off and you get 0 days, but then we remember that the buyer is responsible for that adjustment day, so we need to add 1, and so it would be 1 day. The other alternative is you take the adjustment day month, so that would be August, and you say there's 31 days in August, and then you just back up that adjustment day by 1 to August 30th, and there's 1 day left in August that the buyer is responsible for. So either way works. You just have to remember, when you're calculating the buyer's portion, you're always going to include that adjustment day. So you're always going to be worried about, have I subtracted it off and do I need to add it? Or you could back up the adjustment day by 1 and then you would just have the result. When you're calculating the seller's amount, you don't do that. So you don't add a day, you don't back up the adjustment day. It's done a little bit differently. Okay, so that's how we get 369. We take that 123 days, and most people do 123 divided by 365. You get a fraction from that, and then you would multiply that answer by your tax amount, which is $1,095, remember, because you don't include the penalty for the buyer, because the buyer has nothing to do with that penalty. The seller needs to pay every penny of that. Okay, so that's how we get 369. The next thing that's mentioned is the commission of 6% of the purchase price. So you just take 6% of that $150,000, and we're going to debit that to the seller. So that ends up being $9,000. So there's the $9,000 here on the seller's statement. The next thing is, it says that property transfer tax is payable and that it's not a leap year and Parker isn't a foreign entity for property transfer tax purposes. Now, why do they mention this part? Remember that foreign buyer's tax, that extra 20%, if you are considered to be a foreign buyer, is added on top of the normal calculation for property transfer tax for our PTT. So since he's not a foreign entity, then we just calculate with the normal tiers. In this case, it's only tier 1 because it's $150,000 purchase price, and tier 1 is up to $200,000. So you take 1% of $150,000, and you need to remember the tiers. You need to remember that tier 1 is 1% of the first $200,000. Tier 2 is 2%. Okay, so the percentages kind of line up with the tier numbers for the first 3. So tier 2 is 2% of the next amount, and it up to $2 million. So you're not calculating 2% on $2 million. You're calculating it on the remainder of the $2 million, which is $1.8 million. So if the purchase price is $2 million, you would calculate the 1% on the $200,000, and then you'd calculate 2% on the remaining $1.8 million. If the purchase price is $300,000, then you calculate the 1% on the first $200,000, and you'd calculate 2% on the remaining $100,000 if it were a $300,000 purchase price. Okay, so 1% of that $150,000 is $1,500, so we would add that to the buyer's statement under the debit column, and we would not have it show up on the seller's statement at all. And I just realized that I skipped the conveyancing fees, so we have to add that on as well. So the conveyancing fees, it doesn't say what they're related to, so you assume that they are the buyer's cost because it is for the purposes of transferring title into the buyer's name, so we would need to debit that to the buyer as well. Okay, so you have to remember it's a little bit different now. The rules for calculating the property transfer tax are different, and you only calculate it and add it to the buyer's statement if it says so in the question. Okay, if it doesn't mention the PTT, then you do not calculate it. If it mentions PTT in the question, then you calculate it and you add it to the buyer's statement. So we've taken care of everything. It's all done. So now we just need to actually add up all the numbers and figure out what Parker needs to pay in order to complete. So Parker, like we said, was the buyer. So we're going to take care of the buyer's statement here. So we're going to add up all the credits and then subtract all the debits. And a lot of people, they want to start with the first number and then go down to here and take care of all these and then go back to here, and it's too confusing for people to know whether you're subtracting or you're adding. It's a negative or a positive. The easiest thing to do is you just add up all the credits and you get whatever your result is for the credits, and then you subtract from that all of the debits. And I'm just going to add in the conveyancing fees here that I missed from the previous order there. So we're going to make sure that we take care of all of that. We get $120,000 for all the credits, and then we're going to subtract all of those debits, and we get $32,469 that Parker needs to come up with to complete the sale. Okay, the next one, property is sold for $175,000. So we'll take care of that purchase price first. It is a debit for the buyer and a credit for the seller. The next thing that is mentioned is the real estate commission, and it says it's 5% on the first $100,000 and 2.5% on the balance of that sale price. So I just want to point out that this real estate commission calculation has nothing to do with the property transfer tax and the tiers that are part of that property transfer tax. So the real estate commission is talking about the real estate agent's commission, and the seller usually pays for that. So you just do the calculation however they tell you to in the question. So for this one, 5% of that $100,000 is $5,000. And then you would calculate 2.5% on the remaining $75,000. So that is another $1,875, and that would be the total between those two would be the amount that the seller needs to pay for real estate commission. So you see I have it broken down so that you can see the calculation, but the total commission is $6,875. So the next thing mentioned in the question is the taxes, the property taxes for the current year, and it tells you here in the middle of the question that the adjustment, possession, and completion day is July 28th. So the current year's amount was $516, and they were paid by the seller as usual, properly, as they should have. So we need to take care of the buyer's portion of the property taxes, right? Because the seller already paid, the buyer is going to move in on July 28th, and they're going to be in the property for the lesser amount of time in the year. So we need to be able to do that calculation. So you count the days. So December has 31 days, November has 30, October 31, September 30, August 31. So that is all of the full months that you have that the buyer is responsible for. So that ends up being 153 days. And then the buyer is also responsible from July 28th to 31st. So again, you can do that in a couple different ways. You can do 31 minus 28 is 3, but then we have to add the 28th on, which would be 4 days. Or if you're lazy like me and you know that you're doing the buyer's portion, you can just back up that adjustment day by 1 and then just get your 4. So it would be 153 plus 4 is 157 days. So 157 divided by 365. When you do that and you get whatever the decimal is, then you would multiply that by the $516 to get the amount of the tax that the buyer is responsible for. Then you would debit that to the buyer and credit that to the seller. So here you go is a nicer way to actually write it out. So 157 days out of 365, that's your decimal. Multiply that by 516 and you get $221.95 because that third decimal is a 0. So you would debit that to the buyer, credit that to the seller. You ignore the 516, it's not late, so it's not recorded. Okay, so debit to the buyer here and a credit to the seller. The next thing it says is the buyer has paid a $20,000 deposit to the brokerage, so that has nothing to do with the seller. So we want to credit that to the buyer and it wouldn't appear on the seller's statement. So remember, deposits and mortgage monies are always a credit for the buyer. It's really, really easy to remember that. Legal fees for conveyance amount to $384. It doesn't say that it has anything to do with the seller. So when it says conveyance, it means transferring the title to that property into the buyer's name. So the buyer is the one who would need to pay that. So we would debit the buyer and we would not have it appear on the seller's statement. No exemptions apply to this transaction, so PTT is payable upon completion. It says it's not a leap year and that the buyer is not a foreign entity for property transfer tax purposes. So we need to calculate the PTT and add it as a debit to the buyer's statement. So it's $1,750. Why is it that amount? Because $175,000 falls in the first tier and it's only 1% of that amount, which is $1,750. So we've done everything. We've taken care of everything mentioned in the question. So now we can do our final calculation. So you just add up the credits and subtract the debits because it's asking for the balance due to complete from the buyer. So when you take your $20,000 and you subtract your $175,000 minus the property tax amount of $221.95 minus the $384 legal fees and the $1,750 in PTT, you end up with a balance due of $157,355.95. And that is the amount that the buyer needs to come up with in order to complete the transaction. Okay, so this is a shorter question. It just is asking you what amount of tax would appear on the seller's statement of adjustment. So it's not asking you to do a full question. You don't have to worry about every single thing that's mentioned. We just want to see what the seller's amount would be on the statement. So this one is exactly the same calculation that we did in the previous question. So the full amount is $516. The seller paid. The buyer's portion, we would charge that as a debit to the buyer and credit the seller. So you find out the days. So again, 31 in December, 30 in November, 31 in October, 30 in September, and 31 in August is your 153 days. And then we said from previous that it was another 4 days in July. So the 28th, 29th, 30th, and 31st. So 157 days total. 157 divided by 365 gets you the fraction of the year that the buyer is responsible for, and then you multiply it by that $516 and you get your $221.95. So that is a debit to the buyer and a credit to the seller. So this will show up on the seller's statement. Again, because the seller already paid the $516, the $516 does not show up on either statement. So this is the only amount taxes for property taxes that will appear on the seller's statement. Okay, so it's asking how much the seller will receive on completion. So I've sped things up here a little bit just to get us through the question quicker. So the $120,000 Sale price, the 5% commission, and the current taxes were paid of $1,095. So I've got the $120,000 credit for the purchase price. The commission is $6,000. And when you figure out the buyer's portion, because we're talking about August 30th is the adjustment date, then we would find the buyer's portion based on that date, and then we would debit the buyer and credit the seller. So you count up the days, so 4 full months, which would be 122 days. This is actually a typo here. It should be 30. So 122 days plus the 2 days in August. So August 30th and August 31st would be 124 days out of 365 in the year that the buyer is responsible for. So you do that division, you get the portion of the year that the buyer is responsible for, you multiply it by the tax, and you get your $372. So $372 would be a credit to the seller, and it would also appear as a debit on the buyer's statement. So then it says how much will the seller receive on completion. So you add up the credits. So $120,000 plus $372 is $120,372 minus the debit of $6,000, and the answer is $114,372. Okay, so this one's laid out a little bit nicer. It's kind of in a grid style, so it's a lot easier to pick out the info. So calculate the cash proceeds of the sale. So it's the seller that we're going to actually worry about. If you're practicing, then do both the buyer's and the seller's statements, because like I said before, it a lot of times will help you realize what your mistake is if you're having troubles getting to the answer. So the price is $195,000, so you want to debit that to the buyer and credit the seller. Then the deposit that's been paid to the brokerage, we want to credit that to the buyer, and it doesn't appear for the seller. So we'll take care of both mortgages at the same time. So the first mortgage is going to be an assumed mortgage. So the seller is going to provide that, right? Seller provided mortgage, vendor supplied mortgage. So $71,000 needs to be credited to the buyer, and that one will be debited to the seller as well. There's a second mortgage that the buyers figured out on their own, so we need to give that $34,000 as a credit to the buyer as well. So there we go, we have them all on there. Now it says the taxes in the amount of $1,500 are not due for completion, before completion. Why? It's because the adjustment day is on June 30th. So in this situation, the buyer is going to take over the property, and then they're going to pay the taxes directly to the city on their own a couple days later. So in this case, because the seller is going to be in the property for the lesser amount of time, we figure out the seller's portion, because the seller is going to need to pay the buyer for their amount, because the buyer will be the one that pays. So in order to do that, then we will calculate the number of days, multiply it by the $1,500 tax amount, and then we will debit the seller and credit the buyer. So here we go. We have 31 days, 28, 31, 30, 31, and 29. Why am I doing 29 for June? The reason why is because June 30th is the buyer's responsibility. So June 30th onward, the buyer pays, and up to June 29th is the responsibility of the seller. So January has 31, February has 28, March has 31, April has 30, May has 31, and June has 30 days, but the buyer's responsible for June 30th. So you add all of those up, you get 180 days, divide that by 365, multiply by $1,500, and you get $739.73, because the third decimal is a 6, so we round up 72 to 73. Then the other thing we need to take care of is the commission. So it says it's 6% of the sale price, so we take 6% of $195,000, and we would need to debit that to the seller. Again, remember, the seller typically pays the commission. If the buyer is going to pay part of or all of the commission, it would need to say that in the question in order for you to know it. So it doesn't say who's paying, so we assume the seller, so we take 6% of $195,000 and we debit that to the seller. Okay, the next thing is the conveyancing fee. So conveyance for transferring title from seller to buyer. So the buyer pays that. So we would debit the buyer and it doesn't appear on the seller's statement. And you also see that we put the commission here in the debit column for the seller. Then we have no mention of PTT. So there's no mention in this question of PTT, so we don't actually calculate it. We would just get our final answer, so our cash proceeds. So you add up the credits and you subtract all of the debits. So our credit here, the only one is the $195,000 purchase price, and then you would subtract all of the other debits. There should be a negative in between here, a subtraction in between. So your answer is $111,560.27. Okay, so next one, Mr. Smith is contracted to sell his house to Mr. Jones for $200,000. So that is a debit to the buyer and a credit to the seller. Mr. Jones has paid a deposit of $15,000. It doesn't say where the deposit is going. So if it doesn't mention where it's going, you assume that it's going to go to a brokerage or a lawyer in trust. Okay, so unless it says that it's being paid to the seller, don't assume that. The majority of times, common practice is that it's actually held in trust by either a lawyer or the brokerage, or in some cases, the brokerage's lawyer. So $15,000 would need to be credited to the buyer, and it doesn't appear on the seller's statement. And then you notice that it says that the balance is in cash. So that means there are no mortgage amounts for this question that we need to worry about. Okay, so we move on. The conveyancing fees are $350. So again, the buyer pays for the conveyancing fees unless it mentions that they're connected to the seller somehow. So that would be a debit to the buyer, and it does not appear on the seller's statement. Taxes are prepaid by the seller, totaling $800 net for the period of July 1st to December 31st. So there's a key word that I need you to pay attention for when you're doing these kinds of questions. Whenever it says net, the word net in accounting means that something has already been subtracted or something has already been calculated and subtracted. So for this one, the word net and the fact that it says from July 1st to December 31st, it's telling you how much the taxes are for that period of the year. And if you notice, the question says that the adjustment date is July 1st. So they've already done the tax calculation for you. They've already told you the net amount is the actual amount for that portion July 1st to December 31st. So you don't even have to calculate anything for the buyer. It has already been done for you. Now what they're hoping you're going to do is they're hoping you're going to think that $800 is for the full year, and that you're going to split it in half and you're going to debit the buyer and credit the seller. But you don't want to do that because it says that it's net for that specific period and it's not for the entire year. So you just go ahead and debit that to the buyer and credit that to the seller. Okay, the next thing is the commission of 5%. So it's 5% of the purchase price. So we would debit that to the seller. So that's the $10,000 that's there in the debit column. And then it says a property transfer tax will be due on completion. And it says that Mr. Jones is not a foreign entity, so it's just the property transfer tax that you calculate, the regular tiers. And the purchase price is $200,000, which falls in the first tier, so it would just be 1% of that $200,000, and that would be a debit for the buyer, and it wouldn't appear for the seller. So there you go. You see that the $2,000 is on the buyer's statement in the debit column. So now we can go ahead and figure out our balance due to complete. So you add up all the credits and you subtract the debits. So $15,000 for our credit, or one credit for the buyer. And then you subtract $200,000, $350,000, $800,000, and $2,000, and you get a balance due of $188,150. Okay, so this question is just asking about Penny's share of the taxes. So Penny is the buyer. So we want to figure out the property taxes, what is going to show up on the buyer's statement. So it's good practice to figure out what's happening with the rest of the stuff that's in the question, like where all the other amounts, if they're going to show up on the statements, where they're going to actually land. So the purchase price here is $140,000, so that's a credit to the seller and a debit to the buyer. Okay, and then the property taxes, the thing that we're actually concerned about, it says that $2,300 actually were assessed and they were paid by Victoria on July 15th, and that there's an outstanding late payment penalty of $85, which Victoria hasn't paid yet. So normally when we have like the late penalty fee, we would actually debit the amount of the taxes and the penalty to the seller. So like this is what we would normally do. But in this situation, technically this is not correct because we wouldn't actually debit the $2,300 to Victoria, the seller, because they were already paid by Victoria. So the only thing that we're concerned about now is that $85. If you were doing a full statement, that's how you would take care of that. So we find the buyer's portion of the $2,300 that was paid. And so to do that, we're going to look at the adjustment date, and it says it's December 28th. So we find the buyer's portion, right? Because the buyer's going to be in the property for only a tiny little amount in a year. So from December 28th, so how would you do that? You could do 31 minus 28 is 3, and then you have to add the 1 day, which is 4 days. Or if you're lazy like me, if you know you're finding the buyer's portion, you just back up that adjustment date by 1, and then you get those 4 days. So 4 out of 365 is a tiny little fraction of the year, tiny little decimal of the year, and then you multiply that by $2,300, and it's $25.21 that the buyer needs to pay to the seller. So we would debit the buyer, and that ends up being a credit on the seller's statement. So the answer for this one, because it is the buyer, Penny's share of the property taxes, the answer is that it will show up as a $25.21 debit on the Penny statement. Okay, a little bit longer of a question. So this is where they get a little bit more detailed. Not really more complicated, just a little bit more detailed. Okay, so let's go. $140,000 purchase price, so debit the buyer, credit the seller. Penny has saved up $15,000 and she paid that to her brokerage as a deposit, and she got a $92,000 mortgage from her bank for financing. So both of those are going to be credits for the buyer, and both of those will not appear for the seller because the deposit is going to the brokerage and the mortgage financing is coming from the bank. Okay, then it says conveyancing fees of $690 and a mortgage administration fee of $250 are both payable by Peggy. So Peggy is the one who the home is being sold to. So those are both the buyer's responsibilities. So we're going to debit those from the buyer. And then it says Vivian, the seller, is paying a 6% real estate commission to her brokerage. So we need to debit that to the seller. So you see the $690 and the $250 for the mortgage stuff, and the conveyancing is here for the buyer, and the $8,400 commission that the seller is going to pay. So Vivian has agreed to take back a short-term mortgage for $8,000 to help Peggy finance the purchase. So that's a vendor-supplied mortgage, so we need to credit Peggy and debit Vivian for that one. And then it says, in addition, the conveyancer will be discharging the existing mortgage on title, which has an outstanding balance of $12,000. So for that one, that needs to go on the seller's debit side because that is left over an existing mortgage that the seller had on that property. So we need to put that on the debit side for the seller. That is not being assumed by the buyer, so that doesn't show up on the buyer's statement. Okay, so there you go, the $8,000 for the vendor take-back mortgage and the $12,000 debit here for the seller for that other mortgage that was sitting on title. So it says property taxes of $2,300 have been assessed. They were paid in full, just like we had in the previous question, but there's an outstanding late penalty. So we need to take care of that late penalty, and then we need to figure out the buyer's portion because it said earlier in the question that the adjustment date is December 28th. So we're going to do the same thing, same calculation as we did in the previous question. 4 days, right? December 28th to 31st is 4 days, times that 2,300 is $25.21. So we would debit the buyer, credit the seller, and we would also slap that late penalty of $85 on the debit column for the seller. Okay, so there you go. That's what it looks like. And then it says Peggy is going to be responsible for paying property transfer tax, the PTT, on completion. And it says later in the question it's not a foreign entity, and it's never going to be a leap year. It says it in every question, but it's never going to be a leap year. So there's not a foreign entity, so we don't have to add the additional 20%, and then it's asking for the cash proceeds. So the PTT is payable on that purchase price of $140,000. Since the $140,000 falls within the first tier for PTT, it's just 1% of that $140,000. So you see that there's $1,400 here for PTT. That's put in the debit column for the buyer. So you add up all the credits. So 15,000. We're doing cash proceeds of the sale. So pay attention here. So we're going to add up all the credits. So 140,000 plus $25.21, and then you subtract all of these debits. So minus the 8,400, minus the 12,000, minus the 8,000, and minus the 85, and you get a $111,540.21 for the cash proceeds. Okay, next one. It's kind of a weird one. If you haven't done your math yet, then you probably won't be able to solve this one. If you've done the math section already, if you started with that, maybe you were an in-class student and you did this first, or you decided to tackle this first, if you are an online student, then you will know how to solve it. If you haven't done the math yet, then just skip it for now and come back to it. Don't stress about not getting the answer correct. It's a pretty simple question. It just says that there's a revenue producing property that's been sold and the adjustment date is January 31st. It is exactly 18 months after the contract to purchase and sale was signed, and this deposit of $3,500 was paid. It was paid directly to the seller, and it's saying that the interest on this deposit is going to accrue for the benefit of the buyer at 6% per annum per year, compounded annually, and it's saying what amount will show on the seller's statement of adjustment. So basically what they're asking you to do is to calculate the accrued interest. So this is like an accrued loan, right? Interest accruing loan calculation from your math. So basically you would enter $3,500 for the PV, and then your future value is what you're finding, because the future value in an interest accruing loan includes the original PV, the original amount, and all of the interest that's accrued to date. So you just go ahead and solve using your beginning box, right, for your math. J1 equals 6. There are no payments. The time is given in months, so we have to convert it to a J12. So you do your INPEPIN. When you're done your INPEPIN, you get 5.8410, blah, blah, blah. And then you enter those 18 months straight in. So don't enter it as 18 shift N or 18 times 12N. Otherwise, the calculator will think that that is 18 years instead of the 18 months. So you just do 18N to enter that, and then 3,500 into your PV, 0 plus minus in your payment key. And since you did an INPEPIN, your IYR and your PYR are already taken care of, so you don't need to re-enter those again. Once you've entered your payment, then you press your future value and you get the answer of $3,819.68. So it's to the benefit of the buyer, right? The interest is to the benefit of the buyer. So you need to actually credit the buyer for the original $3,500, right? Plus all of the interest that is accrued, which is included in this $3,819.68. So in here, the PV of $3,500 is included. So the interest is $319 and change. So we credit that to the buyer, and it would be a debit to the seller. So that is what the answer is. It would be a debit to the seller because they have to pay that interest to the buyer. Okay, so the next one, let's do multiple things at once so that we can be a little bit more efficient, right? This is what you guys should be doing to cut down the time. You're trying to sort of manage your time better and take less seconds, less minutes to do these questions. So sellers agreed to sell her home for $155,000. So that is a debit to the buyer and a credit to the seller. The buyer paid $5,000 deposit to the brokerage, so that is a credit to the buyer and it won't appear on the seller's statement. The buyer will assume the existing mortgage on title, which has an outstanding balance of $71,000. So that we need to actually credit to the buyer and debit to the seller because that one is a vendor supplied mortgage. And then this second mortgage is coming from daddy, so that one just gets credited to the buyer. It says taxes are unpaid and overdue in the amount of $1,095 and a penalty of $105. So we need to debit that $1,095 and the $105 directly to the seller right away before we figure out the tax portion for the buyer because the adjustment date is August 31st. Real estate commission, 6% of the sale price. So we debit that to the seller. That won't appear on the buyer's statement. The conveyancing fees for the transaction are $600, so we need to debit the buyer. That won't appear on the seller's statement. And then it says property transfer tax is payable on the transaction and the person is not a foreign entity, so then we would just calculate 1% on that $155,000 sale price. So when you get all of that written in, this is what it will look like. Okay, so here's the sale price, $155,000 on both sides. The $71,000 vendor supplied mortgage, the $1,095 taxes and $105 penalty for the seller, the $9,300 for the commission for the debit for the seller, and then the $34,000 daddy loan, the $5,000 for the deposit, and then the $600 conveyancing and the PTT of $1,550, and then this $369 is the tax portion that's calculated right here, and we are finding the buyer's portion, like I said, because the buyer is going to be in the property for the lesser amount of time, and the buyer needs to pay their portion to the seller because the seller paid. We made them pay here even though they were late, and they didn't. So 123 days, so August 31st, so December has 31, November has 30, October has 31, and September has 30, plus that 1 day in August. August 31st is 123 days, so 123 divided by 365, and you multiply that by the actual tax amount, not by the penalty, right? Because it's just the taxes, and you get $369. So what are the cash proceeds that are going to be there and available for the seller? You add up the credits and you subtract all the debits. So when you do that, you get $73,869. Okay, so Garth has agreed to buy Whiteacre from lease of blah, blah, blah. What are they asking? The property tax amount to be paid by Elisa will appear on her statement as what? So we're just doing the property tax calculation. We're not going to worry about the purchase price. We're not going to worry about any other information that they give in the question. Now this one's a little tricky because it says that the property taxes aren't due, and the taxes last year were $1,324, and the notary public has told Garth to expect a 10% increase. So the completion and adjustment dates are in February 18th. Now, why would you have to project how much of an increase in taxes that you might expect? Well, this sale might have actually gone firm in the previous year. So we might be in December or maybe even November when this contract was signed, and we don't quite know what's going to happen with the taxes yet. So the notary is just saying, hey, the trend has been roughly 10% increase every year. So that's what you should pay, and that's what everybody's agreed upon. So in this case, the taxes in the previous year were $1,324, but you have to add that 10% increase. Now, this is the easiest way to add percentages in your financial calculator. So you should do it this way that's written here. And the reason for that is because it will cut down the likelihood that you're going to make a mistake in converting that percentage to a decimal and then multiplying it and writing it down and then adding it to the $1,324. When you do it this way, 1,324 plus 10% equals, the calculator will calculate the 10% on the amount that you entered before. It will add it because you did that as your operation. You said plus 10%, and then it will give you the result all in one fell swoop. So when you do that, the projected property taxes are $1,456.40. So because it's February 18th as the adjustment day, we're going to find the seller's portion, because the seller is going to be in the property for the lesser amount of time, and they're wanting Elise's portion, so she's the seller, so that makes sense that we would actually calculate that. So $1,456.40 is the amount that we're working with. So we count the days, so 31 days in January and only 17 days in February, because February 18th is the adjustment day, and that is the buyer's responsibility, and we are trying to find the seller's portion, Elise's portion, okay? So 31 and 17 is 48 days, so 48 divided by 365 is your fraction of the year, and then you multiply that by your 1,456.40. You get $191.53, because that last decimal is a 6, and that would be a debit for the seller, because that is the amount that the seller owes to the buyer, because the buyer will be the one to pay the taxes in July. Okay, so this one, another question, a little bit longer than the rest of them, and it has a couple little tricky bits in here. So all of the stuff that's highlighted are the items that we need to worry about, the things that we need to worry about. So if you're not comfortable with doing sort of multiple things at once, then just take care of everything one by one. I'm going to kind of go over it a lot faster, because hopefully you're getting more comfortable with the questions at this point. Okay, so the first thing we're going to take care of is that property taxes calculation. And in question 14 that we just that I just showed you, the property tax calculation is exactly the same as the previous question that we did. So the 10% increase on the $1,324 tax bill for the previous year and the February 18th completion date is all the same. So the tax calculation is exactly the same as the previous question, question 13. So the $191.53 is what you should come up with when you do that. Okay, so that's what you see here, $191.53. Okay, so we've got the $448,000 purchase price as a debit to the buyer and a credit to the seller. We've got the $25,000 deposit that went to the notary public, so we credit that to the buyer and it doesn't appear for the seller. The next thing is the commission of 5% on the first $100,000 and 1.5% on the balance. So the balance that you're going to calculate that 1.5% on is $348,000. So that is right here. $5,000 was the 5% on the first 100,000, and the remaining amount of 348,000 is 1.5%. So that's the $5,220. Then the property taxes aren't due yet, and it says that the increase is $1,324 plus the 10%. So that was the $191.53 that we have here. Then we deal with the assumed mortgage. So Anya is going to allow Carl to assume her first mortgage of $123,544. So we credit that to the buyer and we debit that to the seller. There's another mortgage of $98,000, which Carl is taking care of on his own. It has nothing to do with the seller, so that would just be a credit to the buyer. The balance of the purchase price and the property transfer tax will be paid out in cash out of the proceeds from the sale of Carl's other property. Now, this one is a little bit tricky here. I just want to make sure that you pay attention to this part here. A lot of people say, well, if it isn't part of if it's not going to be paid from this transaction, then I shouldn't put it on these statements here. And that's not true. We need to actually keep track of all of the money that has to do with this transaction. So if Carl is selling another property and he's going to use that cash proceeds that he gets to take care of his balance due here, then that'll be taken care of by his lawyer. But we need to make sure that we take care of all of the items that are related to this property on these statements. So the rest of the purchase price definitely will stay, right, in that $448,000 amount. And then the PTT still needs to be charged on this statement. So the debit would definitely be there for that PTT amount, so $6,960. And we'll show you how to do that calculation in the next question. So Anya is going to pay out of her existing second mortgage. She's going to pay out her existing second mortgage of $23,000. So we debit that to her, right? And then the notary fees are $700 for the conveyance and $250 for the prep of Carl's new mortgage. So Carl gets debited for both of those. And then the $75 to discharge Anya's second mortgage of the $23,000, she needs to pay for that charge for that. So we're done with everything. It's saying what is the cash proceeds of the sale. So we're going to find out the seller's statement total. So we would add up the credits and subtract the debits. So here you go, $448,000 minus all of the debits on the seller's statement gives you a cash proceeds of $290,969.47. Okay, so this last question, question 15, it's not numbered, but it is question 15, is very similar to the last question. In fact, it's exactly identical. It just has different names in it, but all of the amounts are exactly the same. The only difference is that you are now going to calculate the balance due instead of the cash proceeds like we did in the previous question. So we are going to add up all the credits and then subtract all of the debits. And so the PTT here is the other thing that you have to pay attention to for this one, because remember it said that the sale of another property was going to take care of the PTT and the rest of the purchase price. We still have to record both of those items on this statement because both of those dollar amounts are related to this property. So we still need to calculate the PTT and subtract it off. So in this case, we would actually include that $69.60. So our balance due would be $209,174.47. So hopefully you found this video helpful. The only way that you're going to get better at these questions is if you practice them. So what I mean by that is don't just get through this section of your course and then try and forget about it like it never happened. What I mean is you will need to come back and review these questions and practice these questions several times so that they don't trip you up on not only your mock exams but also on the real exam. So you want to be doing these questions in a relatively short amount of time, and the only way that you're going to be able to do that is if you practice. Okay, so the key for math is any math, the regular math, the math type questions, any math that you actually come across in your everyday life. The key to being good at the math is to be consistent and to practice. And so you need to be able to do both of those things in order to get good at these questions. So good luck, be happy, have fun, and I will see you in the next video.